When it comes to investing, retirement, taxes, healthcare, and estate planning, the decisions you make today can greatly affect the quality of life for you and your loved ones tomorrow. What you need is straight and unbiased information on the most important issues you'll face when planning for your retirement and financial future. Good news, you found Premier Retirement Radio with Jeff Hogan. Jeff is the founder of Premier Retirement Planning and Wealth Management, and he's been guiding people financially and into retirement for 30 years. So get ready for an hour of the most comprehensive financial information on the radio. Premier Retirement with Jeff Hogan. And now here's Jeff Hogan and Jeff Shea.
Thank you so much. Welcome to Premier Retirement with Jeff Hogan, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about whether or not a recession is looming. Also, 6 ways to simplify your estate for your heirs. We'll answer listener questions and then target date portfolios. Are they good for your retirement? My name's Jeff Shea, and as always, I'm just here to ask the questions, but the words of wisdom and solid advice, they come from the other Jeff in this radio program, Jeff Hogan of Premier Retirement Planning and Wealth Management. Jeff, how you doing today?
Doing great as always. Fun to be with you and listeners this weekend. How are you doing?
I'm doing great, thank you. Good to be with you. Little traffic getting into the studio this morning. You know, we're coming from Oro Valley. We kind of got to come down to Tucson. Have the snowbirds begun to leave yet, or when can we expect traffic to sort of ease up here a little bit?
Oh, I don't know. I think it's just hit and miss sometimes. Yeah, the weather's getting so good. I think people are trying to start earlier now rather than, especially the winter visitors that don't really have to be anywhere by like 8 or 9, like, many of the working folks. But yeah, or just the honeydew folks on the weekend or whatever. But, you want to get all your stuff done early. Shoot, it's been in the mid to high 90s this week.
Yeah, I know.
I mean, it's not even, it just went from freezing golf weather to don't want to golf because it's too cold. And now it's don't want to golf because it's too hot. So I think everybody's just getting out and about early in the morning and getting their stuff done. But, next month, as soon as tax time's over, it seems like the roads clear up again. So we'll be thinking less bad words while we drive in the future, hopefully near term here.
Well, I'm a recent resident here. I'm looking forward to spending some time here in Tucson. Hopefully this is going to be my home for the rest of my life. But yeah, Oro Valley is a great place. But I do know that you got to take Oracle in order to get down to the office here. So I'll keep that in mind. And I'm ready for the triple digits. Dry heat, it doesn't bother me that much from all my years in Southern California. So anyway, glad everybody could join us this week. We're not here to talk about the traffic or the weather. We're here to talk about your finances. I have been seeing a headline recently, Jeff, which says, "Is a recession looming?" And it gave us many reasons why they think a recession is looming. And often I take these headlines with a grain of salt because I think it's just clickbait, but I wanted to get your opinion on this. Some financial experts think a recession is around the corner because of a number of different factors. The first one is higher interest rates, and then they go on to talk about inflation. So do you think that high interest rates and inflation are necessarily a sign that a recession could be looming?
Well, I don't even know why it's being looming. I mean, if you look at the statistics, we've been in a recession as far as manufacturing going down, job growth going down, wages not going up to keep up with inflation. Inflation numbers are getting higher. If you're an economist under the old school rules, you'd think we've been in a recession for about 2.5 years since the market started crashing. Of course, they were doing some backdoor financial maneuvering with banks, giving them quantitative easing to the banks so they could buy stocks and not to declare their bad loans as bad loans and kind of basically cook their books. So they looked like, the banking system was healthy to give a little bit of confidence to the market. But even still, we've been seeing, insider trading, not insider trading, but insider selling and smart money selling. I just read a statistic that it was selling at 12 to 1. In other words, the dumb money, the people out on the street, Main Street, are buying 12 times more than institutions right now. Institutions are kind of liquidating their holdings. And, I don't think they would do that unless they had some economic understanding of where the market is. So, there's been 6 or 7 different graphs you can look at that, if you look at history, always end in recession. The balloons have been getting overinflated. I'm probably counter to the mainstream as far as a financial guy, because, if I can go out in town and cheerlead, get in the market, hurry up, man, you got to come, bring your money, man, I'll invest it, I'll manage it for a fee. When I do better, you do better. And, we're a fiduciary. We'll just throw it at the market. Market always goes up. Don't worry. Long haul, it's always good. Well, in the long haul, how long is the long haul? Well, if you have a lost decade like 2000 to 2010, the long haul for you is probably 20 years or more. I mean, do you have 20 years if you're going to get retired? Or are you going to get into retirement in a year or two, or if you're already retired? There's a lot of just cheerleading and basically sales talk in the industry that always we want to be bulls. And long term, I am a bull. I prefer to be optimistic. I prefer to look at the market when it's good, but I also prefer to buy when it makes sense to buy. Anybody who's been in this business, like Warren Buffett, who's been in business longer than Warren Buffett, why is he selling? Why is he continuing to sell? He's net adding cash to his portfolio to the tune of, a third of his $1 trillion in Berkshire Hathaway is cash. Why would he be doing that if he thought that, we're not going to have a recession and then we're not going to have some big market correction? And the fact is you can have a market correction without a recession. So are we still going to have a market correction? I still think we're going to have a market correction, but we've already had recessionary pressures. I mean, the higher interest rates caused a big recession on real estate. I mean, the only real estate market out there is for cash buyers nowadays because nobody can afford the 7% loans on a house that's twice as high as it was 5 years ago. Some people can. The rich people can. The people that have bought NVIDIA and were well enough heeled to have a bunch of money in the stock market and took advantage of this manipulation that we've seen in the last few years. But from the standpoint of fundamentals, which I think actually a recession would certainly help us get back to fundamentals where you could actually buy stock and invest based on things that made sense, based on earnings growth, based on financial future prospects and prosperity, based on the fact that we have a recession, interest rates go down where people can afford to actually borrow money and use money. The economy doesn't grow really without lending. If you look at just the amount of credit, easing up on the loan criteria for people to buy houses and so forth over the last 20 or 30 years is really what's made the economy boom over time. So, interest rates are a big deal with the economy. And if you just want to go back to a cash-only society because nobody can afford to borrow, and by the way, I don't think 7% on a house is outrageous. If you look 20, 30 years ago, it was that, and 50 years ago, it was even more. But yeah, at the same time, prices were a fraction of what they are right now. And so it's all relative. It still has to be within the margin of what you can afford to housing when, food's up, gas is up, all the other costs of living are up. It just costs more to get through life. Insurance is going crazy. All these different aspects of life and expenses are going up. Some industries are actually doing better because they're able to raise their rates. And like insurance companies, for example, utilities are doing good. Nobody's going to not buy electricity and water and power for their goodies. But in industries now with the high-tech chips and the high power that they need are going to need more energy. So there are some sectors that are going to continue to get supported and do okay, and they'll always be able to make money. But overall, it's the guy on Main Street, the middle-class Joe, that is trying to make ends meet that's still suffering. So I think if you ask 50% of the people out there, you can ask all my kids, even though they all make a decent living and are getting by, they're finding it a lot harder to manage even on higher incomes than they did a few years ago. That's obviously slowing down for them. So I think the middle class, the people raising families, people that have jobs that don't own businesses where they can just raise the prices and raise earnings if they have enough demand to support their business, they're suffering. And there's a lot of small businesses that are suffering. I have clients that are running businesses and I'm seeing the incomes that are not going as well as they did the last couple of years. Do I think there isn't going to be a recession? I hope there isn't, but at the same time, I hope there is because things are so overvalued and out of whack. Sometimes it takes a recession just to reset everything. You got to go back to zero. You got to go back to a restart where things make sense again and things aren't insane. And there's a lot of uncertainty out there. We've got the Trump tariffs and things, which I think will work themselves out. Everybody's getting mad at Doge and blowing up cars and shooting dealerships and doing stupid things like, why would you key somebody's car who bought it to try to save the planet and make the world a better place, especially when they're in the same party you are? Yeah. And then you go out and you key their car because they drive a Tesla because the guy that owns the company, not the guy that owns a car, you're going to ruin the guy that owns a car, ruin his life and make his life harder when he's barely getting by. To what? Punish a guy that's a billionaire and isn't getting hurt because you hurt that car? I mean, there's some insanity going out there and it's often politically motivated and it's kind of bizarre. I think some of the manipulation in the stock market is also politically motivated, by the way. Obviously, nobody wants to crash on their watch. Mm-hmm. Trump is trying to prod the Fed. Lower interest rates, it'll be better. Well, interest rates going down is going to create more inflation. You've got all this Bitcoin and stuff, people making money that's not even regulated. I mean, is that not inflationary? Of course it's inflationary, but they want to tout Bitcoin and things that aren't even created by our government. If we're going to have a monetary policy that makes sense, use digital currency, but don't let somebody pull a password out of their rear and call it money and all of a sudden have it be in the mix, buying and selling things, driving prices up when the people with dollars still have less dollars. There's just a lot of things that are really out of whack, things that just don't make sense. I think the misunderstanding is with the smart money. They know things are out of whack, and that's why they've been unloading shares of stock, and the institutions own far less as a percentage of all the equities out there, own less of a percentage than they did a few years ago. Private households are owning more and more because they're getting suckered in to the cheerleading on the news. Buy the dips. Well, these dips are still overvalued. So I'm still going to hold to the point that, yeah, can we still make money in the market? Yeah, if you buy cautiously, if you look at momentum, if you look at the sectors that are being supported, if you look at things that aren't trading at 400 price earnings ratios and growing at a 2% clip, that just doesn't make any sense at all. Or even if they grow at a 10 or 20% clip, well, then get the price earnings ratio down to 10 or 20, not 400. I mean, what is that? 4, 5, 6, 7, 8 times the price a stock should be priced at compared to the historical norms. And then you get the old mantra, oh yeah, but it's different this time. Well, those are the most dangerous words in the stock market, according to John Templeton, who's now passed away, but ran Templeton Fund for years. There's some insanity, I think, that needs to be fixed. And I think a healthy recession would actually fix it. Now, am I urging on bad times for Americans? No, I'm urging people to hunker down and fix their finances, get safe, and prepare for a recession. Obviously, people get hurt with a recession. Unfortunately, it's a cycle. It happens. You cannot have an economy that doesn't have cycles. There's not going to be an economy that never has a recession again. If we don't have a recession this year, we're just pushing it on to kick the can down the road and have it down a little farther. That's what we did in 2022. We were on the verge of a recession, and we should have just let the cycle play out. And if the market would have gone down maybe another 20% and would have shook out some of that wealth and got people with 401ks a little bit better starting point instead of just having to continue to print money, even though they said they weren't, by forgiving banks bad loans, by giving banks loans to cover their own debt. And bank term financing program was supposed to be paid back 2 years ago, March, or was it last year, March? I guess it was a year ago, March. And it was never paid back. They were allowed to continue to manipulate the market and use that money to buy their own stock, prop it up by buying NVIDIA and other stocks and make everything look good. But if you look at the last 6 months in the stock market, things are relatively flat, especially with these big seven, the magnificent seven stocks and so forth. They're flat. There's a lot of signs that the precursors to a recession are here. We also get these little sucker rallies, these bounce back rallies, what we're getting right now. If you look at the volume is way low, even though the market's going up. The volume that drives an upward trending market is typically much higher than it is right now. So there's less buyers. There's less people interested in taking on this overpriced market, yet some are continuing to do it. And it doesn't seem like it's institutions or banks right now. So that's a warning to me that we need to be cautious. Now, as you've heard every radio show, I'm cautious. Am I overly cautious? I'm not going to be overly cautious if the market went down 40 or 50%. Man, I'm going to be all buy. Hey, the market's a great time to buy. Fundamentals are bad. The economy looks like it's got its feet underneath it. Those are times when we want to be in the market and adding to our positions, but not before a sell-off. And when you get this euphoria where everybody buys and everybody wants in, and there's less and less fear like there has been in the past year or two, those are telltale signs that you got to be even more careful. And so I think every few days we get this reprieve where the market bounces. I think it's sometimes short covering. Sometimes it's the cheerleading that people just start buying, or sometimes it's even market makers just gapping the price up by setting a price regardless of what the market is normally willing to pay, because there's fundamentals not driving anything anymore. They can just set a price out there, and there's going to be enough suckers out there that'll buy it, and then they'll be able to sell, their holdings at a higher price. And now I'm talking about institutions, the market makers, the ones that make this market. Now we could take that ride and be lucky for a while, but eventually they're going to get the best of us because they are what we consider smart money. They're the ones that control it, not us. We're their puppets. We're on their strings, not the other way around. So we have to respect that. Again, it's not a doom and gloom or a fear-mongering position. It's basically a realistic position that there could be troubled times ahead. We've got a lot of fix-its in store that Trump has to do to get things back on our feet. It takes a while to get manufacturing to move from foreign countries back into America, even though they're committing billions of dollars into plants and jobs and all these things. It's not going to happen this week, this year, by this summer. It's going to happen next year, 2 years later, 3 years later. Maybe by the end of Trump's term, we'll see things getting a nice base built underneath it for a nice launch forward. Hopefully, he hasn't lost, they haven't been able to trash his name and blame everything that happens between now and then on him as if he's doing it. He's trying to fix and dig us out of a hole. He's got a small shovel, and there's a large pile of crap to bury us out from under. So it is what it is. And again, am I scared? No. Let's just be smart with our money. Let's take principal protected accounts that guarantee against the losses when they come, but still make money while the market's being tweaked and manipulated and pushed up. I mean, I'm okay winning whether I'm right or wrong. So that's an approach that I'd like to take. And I think most of my clients are happy that they're on that road. I get some clients that say, gosh, I wish I'd have made 29% last year. Well, if we were in our growth portfolio, you would have, but you would have been risking your money. And I don't think that's wise. If you were in more of a safe portfolio, made 5 or 6, and, you didn't lose any money, but you didn't have any risk. You should have been sleeping every night like a baby. Some of our insurance products made 10, 12, 18% last year because they're principal guaranteed and they're related to the index. So our safe money actually outperformed our liquid money that we manage. You can make money and you can be safe and you can live on what you've saved and protect what you've worked a lifetime to protect and not worry about recession if you're positioned right. And that's really what our job is. So really, at the end of the day, does it matter if we're going to have a recession or not? Not really. I think we're positioned whether we are, whether we're not. My personal opinions, I think we're at a very high risk for a recession sometime in the next 6 months.
We're talking with Jeff Hogan of Premier Retirement Planning and Wealth Management about the possibility of a looming recession. If you have questions of Jeff, you'd like to sit down with him in a casual environment there in the office and talk about your individual situation and possibly how you can recession-proof your portfolio, or whether or not you are prepared for a recession, or whether a recession is really going to do you any harm, call us here at Premier Retirement, 520-780-9059. You can make that call this weekend if you want. Leave your name, telephone number. Shelley will call you back during the week and set up an appointment for you to talk to Jeff. Again, it's about a 20-minute conversation is all you're going to have, and he's going to answer the questions that you need the answers to put you on a path towards a confident retirement, recession or not. Once again, our telephone number, 520-780-9059. You can make that call right now if you wish. You can also find out more about us online at premret.com, premret.com. Jeff, I want to get to our next topic, and that is simplifying your estate for your heirs. It really can make the process of settling your estate smoother, reduce confusion, and potentially lower costs. So for those people who don't think that they have an estate, Jeff, they say, I don't have any money, I don't have very much. Does everyone have an estate?
Well, I don't know if you'd call it an estate, but everybody's got at least something in their pocket, I would imagine, when they die. But I guess some people don't have much in their estate. Some people have a different mix in their estate. But, I think as far as leaving a legacy, you don't have to leave money or things anyway. You can leave a mark on the world. You can make a difference someplace and still have a legacy. Then that might be your estate. But, when it comes to money, there's a big range of what the estate is. Is it a big trust that your heirs can live on for generations? Is it a small profit in a house or a portfolio that your kids can divvy up and pay off some debt, or just a bunch of personal belongings that have kids' names on them when they come and clean out the house when mom and dad are finally gone? But, estates are different. It's whatever you leave behind, and if you want to do an estate plan that's efficient, you want to leave your stuff to who you want, how you want, with the least amount of trouble, delay, and preferably with no probate or no taxes.
When is a will good enough, Jeff? As you said, some people don't think they have an estate. They may have very little, but they do have something. They have a house. Maybe they've got some Yadro figurines or something in the house. I remember your daughter, Whitney, put little purple dots on the bottom of her grandma's furniture, things that she particularly wanted. So let's talk about the basics of an estate. Does everybody need a will, and how do we get a good will? Can you just go online and pay a couple of bucks and get a will and it holds up?
A will, contrary to most people's belief, is actually a ticket to probate. A will is a court document that expresses your wishes as to how you want your stuff distributed, but it is actually written so that it can be presented in court, analyzed, fought over, and litigated if need be, as far as who gets, what. I guess if you think there's going to be a lot of contests and you want to have a public spectacle of your estate and all the people that are fighting over it, and there's going to be a big fight, maybe you want to hire a big law firm to basically spend all your money so there's nothing left for the people fighting over it anyway. But I say that tongue in cheek and kind of as a facetious remark, but a will is a court document. A will requires probate to actually do what it's intended to do. So my opinion is you don't need a will. You shouldn't have a will, but we do think you ought to have a will just in case you need it. It's better to have it and not need it than need it and not have it. So, the other options are a trust. If you have people you think are going to fight over your stuff, but you have somebody in your family that you trust, or a friend, or even an attorney in the family, or somebody that you trust, and just because they're an attorney or a CPA, you need to put them on as your trustee. Doesn't necessarily make them any smarter or more honest than the next guy. But if you've got somebody that you trust, you can actually let them manage your assets after your demise, because when you die, the trust doesn't die. The trust is still the owner of those properties, and whoever the trustee is has actually the final say so as to where that asset goes or what happens to that asset based on your will, basically I say that not as a will document, but as what are the things you want to do with that stuff and the way you want to treat it. So you can pick the next boss of your estate through a trust and allow somebody to be in charge. That's especially handy if you have a special needs kid or just some kids that don't manage money very well and you want to have somebody in charge of those assets to make sure that they are distributed properly or fairly. You also might want to have in there some of this money set aside for college educations for grandkids. My trustee will see to it that if these people get into college and have a need, that their health, education, maintenance, and support is taken care of even prior to age 18, 25, or 21, or whatever the year is that you decide you want to give that portion of your estate out to that heir free and clear. I prefer trust. It's just easier that way. But something that's even simpler if you don't have a lot of money, as you mentioned, is just to write beneficiaries on everything you own. That is like insurance policies have a beneficiary. IRAs have a beneficiary. Annuities have a beneficiary. Most pension plans make you choose a beneficiary, especially if you're going to choose a distribution plan that has a survivor benefit. So you choose a beneficiary. That isn't a probate item. It's just basically, hey, I'm going to put this person on because I want that person to have this chunk of money when I die, and that person can make that claim directly. It doesn't have to go through probate. You don't have to bother a trustee for it. In fact, some people that use trusts have certain items that they have specific heirs on, like maybe they have 2 or 3 different insurance policies or annuities or an IRA. And they say, I want to leave these 5 different accounts to these 5 different people, but the house, the furniture, anything I have in my stock account, not in these beneficiary-driven assets, just goes into my trust, and the trustee will distribute those to my kids or some to a charity or just hold them in trust for 8 or 10 years so that we can make sure all the kids get to college. Whatever you want to do, you can do in a trust, and it's just between you, the trustee, and basically the family. It doesn't have any court oversight, and all those extra expenses are avoided. It doesn't require probate and those long drawn-out processes that could actually last years, especially if somebody comes in and contests a will. You can have anybody off the street could come and contest a will. Now, it might get thrown out fairly quickly, but it still costs money and time and frustration trying to deal with all that stuff. So the easiest way to do is just put a beneficiary on it. And by the way, not just annuities and life insurance and IRAs have beneficiary designations. You can also do what's called ITF, in trust for, or you can do a pay on death account at your bank, brokerage firms. You can do pay on death on any non-IRA asset. In fact, you can even do a deed in Arizona that's a beneficiary deed where you list the beneficiaries on your deed, and that would also avoid probate. You know, in Arizona, I don't even think there's a house cheap enough that you could own that wouldn't have to be through probate if you didn't have it owned by a trust or have a beneficiary listed on the deed itself. That's a fairly new law. Most people don't have beneficiary deeds, but if you have a deed to your house, even if you don't plan to ever move out of there, you don't have to buy a new house and say, oh, well, my next house, I'll put my kids on it. You can redo the deed and say, hey, I am the owner of this house, and I hereby redirect my deed and the ownership to be me as long as I'm living, or my spouse, both of us while we're living, and then to these people, once we are no longer living, and the court honors that. And so that's a big help to families that might have a very limited estate, but don't want to spend $1,500 or $2,000 or even more for a trust. Some attorneys are out there charging $4,000 or $5,000 just to do a trust to get people out of probate. It takes them an hour or two to fill in the blanks on a boilerplate that they do. If you're paying more than $1,000 or $1,500 for a trust, you're probably overpaying because they're pretty simple documents, as long as you don't have something super detailed that you need to have some customized work done and it needs to have an attorney. But generally speaking, I don't believe it does. We do a lot of trusts and we use doc preparers and they work just fine. So don't overpay for whatever the estate plan is that you get. Don't put yourself into probate just because a will might be the cheapest document you can do. And that's what everybody tells you should do. But I think lawyers love wills because it kind of obligates the people, or it makes it very easy and very convenient for the people to call whatever name is on that will, which is usually the lawyer's office number, and say, hey, so-and-so died. What do we do? Oh, well, great. We'll open a probate and we'll go through this mess and you'll pay 8 to 10 or 20% of your estate and fees. Well, it's not always that high. It could be just depending on how big or small your estate is and how complicated it gets and how many contests there are. And some attorneys maybe they work slower, or maybe they just like being so thorough. They charge a lot of hours, and other people a little bit more efficient. So you just never know what you get after you're dead. So why not protect it and set it up more properly while you're alive? That's my opinion. And if you can get it all in order, then that's just one last thing you don't have to deal with.
And Jeff, I think the best advice that I can give folks is to have a locator list. And that is just a list which tells somebody where everything is. And I think your mom has a file cabinet or something that she says, in case anything happens to me, everything you need to know is in that particular file cabinet. So that's our take on what you need, simple documents for estate planning. Again, if you have questions, call Jeff here at 520-780-9059. Sit down, talk with him. He is an estate planner, and set up something that will simplify the lives of the heirs that you leave behind. You're listening to Premier Retirement with Jeff Fogan. Again, our number, 520-780-9059. Going to take a break, Jeff. When we come back, we've got listener questions and more when our show continues here on 790 KNST, Tucson's most stimulating talk.
You can't start a trip you've never taken without a plan, and you can't start your retirement journey without a comprehensive plan to get there safely. To request your no-cost Premier Retirement Roadmap, call 580-780-9059 or request it online at premret.com. Now back to more Premier Retirement with Jeff Fogan and Jeff Shea.
We so much appreciate you joining us each and every week for Premier Retirement here on 790 KNST. Of course, we're here for you on the radio 4 times a week, Saturdays at 7 a.m., 9 a.m., and 1 p.m., and also Sundays at 11 a.m. If you have not been able to join us completely for those times, we're also a podcast. Go to wherever you get your podcasts, search for Premier Retirement with Jeff Fogan. You'll find this show and many of our past shows so you can stay on top of your journey towards a prosperous retirement. Our telephone number today, 520-780-9059. Listening to the program today, you want to get in and sit down and talk with Jeff about your individual situation. Maybe you want Jeff to take a second look at the portfolio that you already have. Maybe you want to request your retirement roadmap. Well, we're offering that as well. No cost and no obligation whatsoever for that. That retirement roadmap is going to take a look at an income plan. It's also going to be investments to support the income plan, estate planning, tax planning, all sorts of things that Jeff will go over. It's about a 30 to 40-minute conversation initially. It can go longer if you want, or even shorter. But again, it's just a casual conversation, and it doesn't cost you anything. 520-780-9059. Make that call today. Shelley will call you back during the week and set up that time for you. 520-780-9059. You can always find out more about us online at premret.com. Jeff, time for listener questions. We'll kick it off this week with Carl listening to us in Tucson. And Carl says, I'm 58 with $1.7 million in my 401k. Should I convert 10% annually to a Roth IRA?
Well, that's a big it depends. It's a very short, I don't have any information to make that make sense. If you converted 10% annually to an IRA, that would be $170,000. What tax bracket would that put you in? Are you already making $400,000 a year, or are you making, what's your household income? Are you making $120,000 a year? Then I would say put 15 or 20% convert to an IRA or Roth and pay 24% tax on that, because I don't think that in the future that's going to be realistic. I mean, think about not doing anything with that 401k. I mean, you're 58, so I'm guessing you're going to be continually adding to it for a while. I would say be cautious as far as what might happen in the market. That 1.7 could easily be less than $1 million in the next market correction if it mirrors anything like we had when the dot-coms busted and when the AI might bust and when the real estate crash kind of took the market down for a good 50%. So if you don't want to have that ride down, or if you say, oh, well, it's okay, I'll always come back, well, that's great. Well, if you want to be in the market and you expect a crash, then I would wait to convert that Roth when your assets are worth $900,000. The thing is you don't know. I would start planning for retirement by maybe taking some of the money off the table and putting it into something that would guarantee you some income based on your projection of tax bracket you'd be in when you retire. Let's just say at 65, 7 more years. And let's say you make 5 or 6% on this 401k plus additions, you're up to $2.5 million. Let's say, you've got things in a relatively safe place, don't lose money, and you make a few bucks. And that's being conservative. You could do that, about $2.5 million. At that point, what are you going to need to retire at 65? Are you going to continue to just take $100,000 out per year plus your Social Security? Maybe you and a spouse has 50 or 60,000 in Social Security and 160 is just fine to live on. Well, maybe that does just fine and you just ride it out and you're always in the 22 to 25% max tax bracket. That's not a big deal. But, like I said, if you're already pushing the 30 or higher tax bracket, I wouldn't convert any money right now while you're working. I would wait till you stop working and then do the conversions. You also might want to look at doing something with maybe, let's just say, $1 million of it, put in a principal protected account that is guaranteed to grow at 6 or 8% a year, for an income account that in 7 or 8 years would be worth, let's just say $1 million would be worth $2 million and generate roughly $150,000 in taxable, but IRA distributions for the rest of your life. I mean, you could do that over those same few years while you're waiting. If you can, maybe move, of the remaining $700,000, maybe you move that into a Roth over the next few years, make all your future contributions of your 401k into a Roth. And again, I don't know if you're making $100,000, $200,000, or $500,000 a year. I mean, if you got 1.7 at 58, I'm guessing you're probably making a couple hundred a year. You've probably got some room to do some Roth conversions, maybe even in the next 4 or 5 years. I try to do it before Trump gets out of office, because I think the next administration, if it isn't another MAGA Trump Republican, you're going to get tax increases, because that's how the other party thinks that balancing the budget is done. And I think they'll try to take it out on who they think is rich. And that's people with big IRAs, big 401ks, high incomes, et cetera. So you want to be as stealth as you can. Another option to do with that $7 million, instead of converting to a Roth, is you might want to even consider a LIRP, life insurance retirement plan, which would generate more cash flow, more safety, and leave a legacy perhaps bigger than a Roth. And the reason being is LIRPs, using life insurance, you don't actually withdraw money from the account itself. You actually borrow from an ever-growing account. So, a 6% return on a LIRP trumps I don't say that tongue-in-cheek, but it's actually better in most cases if you look at even a 10% average rate of return on a Roth IRA, especially if you factor in some volatility. Because in a Roth IRA, if you ever do take that money out, you're actually removing it from the account. It doesn't grow anymore. Even though it is tax-free, you move it tax-free, it doesn't grow anymore. On a LIRP, it continues to grow even though you're borrowing at a rate similar or lower than the rate of return projections should be. So, and I say projections because, history shows that they have been at or below, but there's no guarantee in the future that they would be. But there's also no guarantee that the stock market is not going to go down 2 big crashes in the next 10 years, like the lost decade of 2000, 2010 either. Whereas a LIRP would have no down years and would make money 5 or 6 of those 10 years. And a Roth, might just be going up and down to really generate no returns, even after you've paid tax on the whole amount. So consider a Roth IRA conversion and maybe doing a Roth on steroids. I call the LIRP a Roth on steroids, because if you look at the benefits by it, they're, in my opinion, far greater. You get tax-free growth, tax-free death benefit. The money stays in there. You don't actually remove the money from the account. It's principal protected, meaning that in bad years, you don't lose 20, 30, or 50% of your money. The death benefit can be used while you're alive as a long-term care insurance policy or a terminal illness policy. You have a lot of benefits from that you wouldn't get from a Roth that you might want to even look at, especially at age 58 if you're healthy. And I'm assuming that you're probably pretty healthy. You're still young enough and you're still working. Well, I don't know. Maybe you're not working. I'm just assuming you're going to work for a little longer, but you might want to look at both options. But in order to figure that out, we need your income. We need to put it on a spreadsheet, a plan. We've got a little template that we use here. If you want to come in and check it out, be happy to run that through the spreadsheet for you and see what makes sense. What I want to do is look at your next 30 years and say, how are you going to pay the least amount of taxes and end up with the most money in your account, most income that you can spend, and the biggest legacy that you can leave for your heirs?
Carl, thanks for that question. Of course, we'll send you out Jeff's book, Retirement, The Road Ahead, and we invite you to give us a call here at Premier Retirement. Talk to Jeff personally about your situation. 520-780-9059, 520-780-9059. Jeff, let's jump over to Vail now, talk to Brian. Brian says, it's been a scary ride. My family has $800,000 in stocks. We lost 2 years' worth of market gains in a few weeks. Do we sell or do we buy?
Well, good question. If it's been a scary ride, sounds like you've got scared money in the stock market. I don't think anybody should ever have scared money in the stock market. So you have to do 2 things, Brian. One is don't be scared anymore, or don't be in the market, or how much do you have to take off the table in order not to be scared? Maybe it's half of that. Maybe it's more. How old are you? Do you need that money? Are you using it for retirement, or are you 30 years old and you have 30 years before you'll probably ever need any of that money and you're continually adding to it? It's never bad when you have chunks of money and the market's overvalued like it is to take some profit off the table. Maybe you want to let some ride. Maybe you want to let it all ride. Maybe you don't really care, but obviously you do because you're scared about 2 years of market gains in a few weeks. Could that market bounce back and be right back where it was in another month? Yeah, it could. Could it continue to fall until you're down until you're down 5 years of prior earnings back down to 400,000? Yeah, you could do that too. The fact is no one has a crystal ball. Nobody knows what's going to happen. There's pressures that are, some headwinds on the market that I think are pretty scary as well if you are investing what I call scared money, the money that you can't afford to lose. Can't afford to lose it? Don't be in the market. There's plenty of places to principal protect your accounts, get upside when there's upside, and not lose when there's not. So it's a perfect time for those assets. We've been doing record numbers of assets into principal protected accounts. The cool thing is with interest rates higher than they have been in a while, like 4 or 5% on bonds instead of 1 or 2%, the companies that offer these principal protected accounts are making more money on your money, and all they have to risk is the interest that they make on your money. But if they can bet and use options and leverage and different things, if they can make a 5% return on an investment double, and then they take 1 and give you the rest, that means if they're making 5% on your money and they can make 10 and keep 1 and give you the rest, you make 9. 5 years ago, if they made 2 and could double it, they could make 4, keep 1 and give you 3. And that wasn't really a compelling argument to get into principal protected accounts when, even though you can keep money liquid in bonds or CDs at maybe 2%, and you had some benefits there when the upside in an index annuity might have been 3 or 4. Now the upside in annuities, 10 or better. I mean, we've had some of our indexed products on our life products and annuities that are insurance accounts that are insured principal, secured principal, and all there is at risk is your interest on that given year. And we had some strategies that made high teens and even broke 20 on occasion. So a lot of double-digit returns last year. By and large, those are locked in. Some are in multi-year strategies where they're not locked in yet, but you can lock in any time. If you think, hey, the market's top heavy, I want to make those gains principal. You can do that. So there are different ways to maybe not have a scary ride, yet still have upside based on the market, but you don't have to be scared of losing if it doesn't perform. So again, you give up some of the upside, but you don't get any of the downside. In some cases, that'll actually work out better, not just from a peace of mind standpoint, but if the market gets really choppy, and we do have a couple of recessions / corrections / market crashes in the next decade, like we did between 2000 and 2010. And we've had all kinds of stimulus since then that have kind of kicked that can down the road. So maybe it won't be that next decade based on when he said it a few years ago. I think he died, 5 or 6 years ago? It was before COVID. Those are the things that are looming. Warren Buffett thinks it's going to happen too. I mean, he even said it recently in his recent address to shareholders a few weeks ago. So smart money is telling us what they think, and I don't think they're making that up just so, we'll buy all their stock before the crash. Warren Buffett's raising cash, so we know that he's standing behind his comments for sure.
Brian, thanks for listening to us in Vail. And, of course, if you'd like to talk to Jeff, 520-780-9059 is the telephone number, 520-780-9059. We'll also send you out Jeff's book, Retirement, The Road Ahead. Next question, Jeff, is from Maureen, and we're going to head north to Pima Canyon. And Maureen says, my husband wants to retire in August 2025 when I turn 65. My husband turned 65 in December 2024. We have $1.1 million saved, including stocks, ETFs, mutual funds, along with $1.6 million in a 401k. We will at that time start to collect Social Security. What would be a good rule of thumb for how much we could withdraw from our savings 401k without touching the principal?
Well, there is no rule. Without touching principal, there is no rule for that except use the interest. So if the fixed interest is 4%, then take 4%. If fixed interest is 2%, take 2%. You can't have a rule of thumb that says, without touching the principal. That's honestly a question nobody can answer unless you just have fixed interest. Now, if you don't want to run out of money, now you've got $2.7 million if I add those numbers up. The 4% rule, which is the old William Bangen rule back in 1993, said that, based on volatility and the random returns, if you had a 60-40 split in the stock market, stocks and bonds, 60 stocks, 40 bonds, that in 25 years, as long as you took less than 4% out, you shouldn't run out of money. Well, that's interesting because when he did that study, bonds were averaging about 5% average annualized rate of return in the stock market over the last 100 years. It averaged 10. So how is it that you can only take 4% out? Well, that's because of volatility. When the market's down, you lock in losses. When the market's up, you spend your gains, but they're not growing anymore. So on a withdrawal plan, you keep losing money. Now, I can offer you what most of my clients, affluent clients, what we call the mass affluent, between 1 and 5 million net worth. So you're right in the middle there. Why not take, let's say, half of that money, lock in a guaranteed income let's just say you locked in 1.3 million between you at 65 would generate a little over $100,000 a year. Now, if you took the 4% rule, by the way, that would still indicate that you have a potential of running out of money, a very small percentage, but you could run out of money in 25 years or more, but you have a good chance that you won't. That's a 4% rule. So 4% of 2.7 million is just a little over $100,000. Half of your money could guarantee at least that income from secure, guaranteed, principal protected products with insurance companies. And even if you drew it down to zero and planned to have no money in that account when you died, think if you put that other half of the money in an account. If you're going to retire at 65, let's say you live that 25 years that the 4% rule, is based on 25 years. So in 25 years, in order to double your money, you only have to make 3% for 25 years to double your money. So if you took half your money, lived on basically that same $120,000 a year, guaranteed, probably have something left, by the way. The products that we use have pretty good solid gains attached to them, and probably won't be out of money in 25 years. But even if you are, that other account only has to earn 3%. Now I can set it up to guarantee at least that, for at least the next 10 or 15 years, probably 5. You could probably triple that money. So if you want to be in the stock market and basically kiss the ring of the Wall Street man and say, whatever you say, you're the king, do whatever you want, let them manipulate you into fee-based accounts where they can make money over and over again on your money, then, do that. That's what the mainstream does. That's what they've been indoctrinated to do. That's what they've been programmed to do. And that's probably why all your money looks like it's in 401k, ETFs, and mutual funds, because you probably have never been exposed to a better way and a more secure way. So if you want to retire soon, I would start repositioning right now. And by the end of this year, when you are done with both retire and you want to start using some money, turn that guaranteed income on for $120,000 a year. Let the other ride for emergencies. Let it grow. Let it do whatever it does. And you'll probably give your kids 1 or 2 or 3 times what you start with. So rather than just take a safe amount out that you could actually run out of, take an amount of that you will at least have half your principal left starting on day one, and possibly much more than that. Now, if you want to take it a step further and you want to guarantee your kids a tax-free future retirement, then put of that 1.1 million saved in stocks, bonds, ETF, mutual funds that's outside of the 401k, and put that into something that you never have to pay tax on. The thing I worry about you is you got 1.1 million in stocks, bonds, ETFs. Now, stocks and ETFs, until you sell them, don't actually generate a tax problem, but mutual funds do, interest do, dividends do. There's a lot of things where 1.1 million, you have a 10% year, you could be paying tax on $100,000 of money you don't want to use. What if you could make that $100,000 in a tax-free account that would end up being 2 or 3 or 4 million guaranteed when you die? And that would be guaranteed even if you died next year or a year later. And that would be a LERP, where you could do a legacy plan where you can access that money anytime you need it. It's kind of like your tax-free bank. You can use it for long-term care bills. You can use it for terminal ill bills. You can use it just to buy a motorhome, travel the country. You can use it for whatever you want to, tax-free. And when you die, the balance plus the built-in gains go to your heirs tax-free. So my opinion is you could abandon the Wall Street model and do so much better than the 4% rule that they hold dear to. And by the way, the 4% rule was blown out of water in 2000 to 2010 when they revised the rule to, well, if we have a decade like 2000 and 2010 in your retirement where there's 50% crashes or more, and your money's mostly in stocks, bonds, and mutual funds, or stocks, ETFs, and mutual funds, which I'm guessing you don't have a really much of a bond contingent there. It's all volatile growth stuff. If that's the case, then your withdrawal rate should only be 1.8%. That was done by a guy named Wade Pfau. He's actually, he's a PhD in retirement income studies, and he has certifications and classes that, he's the world-renowned expert on how much is safe based on statistics, volatility, historical returns, random returns, and all the things that could go bad in the future in the next 30 years while you're in retirement based on what's happened in the past. If you believe that the next 30 years is going to be different than the last 30 years, then, be my guest and go down that road. But Wall Street doesn't care if you lose money. They just want to keep your money in their clutches and keep managing it. And, if the market takes your money, well, it's the market's fault. It's not theirs. Well, they should have maybe expanded your horizons and showed you a few more tools that are out there that you could use to build your retirement house. We think you should get your entire house in order. You can't build a house with just a hammer or just a hammer and a screwdriver. You need saws and all kinds of different tools to make that house a strong, firm house. You need a foundation. You need so many things that Wall Street really doesn't provide you. It's a great way to make money, and you've obviously done well. You've got 2.7 million, all based on the fact that you've invested consistently over time in the stock market. You've probably never been scared of the stock market, but I'll tell you when you will be scared is when you're retired, have no income, and all of a sudden the market's gyrating at 10, 20, 30, 40, and 50% in a year, and you see that 2.7 go down to 2 million, and then maybe 1.5 million go like, uh-oh, we have to wait till it comes back before we feel comfortable using any of our money. That's not a good place to be. My opinion is secure all your bills, have to have money locked up, guaranteed, secured, and play with the rest. Then it's not scared money. You enjoy your retirement. You don't run out of money. You have more in the end, and you can even do it on a tax favorable basis.
Maureen, thanks for listening to us in Pima Canyon. And, of course, give Jeff a call if you want to have a further conversation, 520-780-9059, 520-780-9059. Of course, we'll get Jeff's book out, Retirement, The Road Ahead to You. If you have a question you'd like us to answer on the air, you can get it to us by calling it in to Shelley if you want at that number, 520-780-9059. You can also go out to the website, premret.com, use the contact page there. If we use your question on the air, of course, you'll not only get a great answer, but you will also get Jeff's book, Retirement, The Road Ahead. Also, if you want to sit down with Jeff on an individual basis, one-on-one, talk about your individual situation on your journey towards a confident retirement, we're offering this premier retirement roadmap at absolutely no cost, no obligation at 520-780-9059. Jeff, we get questions now and again here at Premier Retirement about target date funds. Can you tell us basically what target date funds are, when they should be used, maybe when they should not be used?
I think they should never be used, period. They just should never be used. I think they're a waste. They're a cop-out for mutual fund companies and brokers to maybe have their teeth on trying to manage portfolios and asset balance. And honestly, I think most of them are automated. They don't really do a whole lot. And they consider conservative bonds. Well, how conservative are bonds when they can go down 20 or 30% over the next year or two, which they did since the beginning of 2002 to even right now? Bonds have tried to make a comeback, and they're getting soft again this week. I mean, they're just not down. The 20-year bond is down more than 20%. The aggregate bond, even including short-term bonds, is still down more than 10% since its high a few years ago. How are you going to make money if half your money? I mean, if you can lose on what's considered the safe part or the conservative part of your portfolio, and they keep you, if your target date is 2030, you've only got 5 more years to retirement, they're going to have you like 60% in bonds and the rest in stocks. Well, stocks have done very well in the last couple of years. So you've made good money on 40% of your money, but you've lost 20% on 60% of your money. So you're probably barely better than break even. Unfortunately, most people who are doing 401ks and use these target date portfolios are in it because they really don't have an advisor or anybody to help them say, hey, you know what? Right now, you should be in the short-term bonds, not any of this long-term bond. These target date portfolios have all kinds of long-term bonds that get hammered. They also have, in the 40% of risk stocks, they have stuff that's very risky. Right now, I think most foreign stock market are doing better or have a better chance fundamentally than the U.S. stock market being overvalued and driven higher and higher than it has been the last few years. So, I mean, you probably have some options to go short-term bonds. You have some options to go maybe less on value stocks, which are more fundamentally driven, that may not take as big as a hit as, some of the overvalued high-tech stocks will. And you can get out of some of the overvalued stuff. Now, it would take an advisor to help you, and unfortunately, 401k plans don't offer that. So, if you do have one and you want us to advise you and give you that, I mean, we do that for clients, knowing that if we have a good relationship, in a few years when you do retire, that chances are you're going to continue to use us. So it's goodwill that we generate. You can also do it on a small fee basis if you want that done. But I'll tell you what, paying a small fee to not lose 20% of what was supposed to be the safe part of your portfolio would probably be worth it if you look at, history and what you could have done. Unfortunately, they're underperforming. They're static. They don't do anything. It just doesn't give me any warm fuzzies at all. I just don't like them. Sometimes they have higher fees. They don't actively manage. They might be a little bit more age appropriate, they say. But as far as performance, you could do way better with just very little research on your own or just spending a few minutes with an advisor that understands the market.
Thanks for that answer, Jeff. And again, if our listeners have questions about target date funds, call 520-782-9059. Sit down with Jeff. He'd be happy to talk to you about those. Actually, anything else that's on your mind as far as your retirement journey goes. Again, our number 520-780-9059. Jeff, out of time for this week. I want to thank you for your time, but most importantly, I want to thank our fine listeners here in the greater Tucson area for joining us. With Jeff Logan, I'm Jeff Shade. Have yourself a great weekend. Talk to you again next week right here with another edition of Premier Retirement on 790 KNST, Tucson's most stimulating talk.
Investment advisory services provided through Premier Wealth Advisors, LLC, an Arizona state-registered investment advisor. Securities transactions are placed through TD Ameritrade. Insurance and annuity products are offered through Premier Advantage Inc., DBA Premier Retirement Planning and Wealth Management. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products. Insurance guarantees are backed by the financial strength and claims paying abilities of the insurance carrier. The show is intended for informational purposes only and is not to be construed as advice or recommendations. Due to show format, accuracy and completeness cannot be guaranteed. Premier Retirement and its representatives do not provide legal or tax advice and may only conduct business with residents of states and jurisdictions where they're properly registered.